Hi, everyone. It's Mike and Alan again with the Gold Silver Show. And Alan has put together a sort of a recession indicator of the economy, a whole bunch of different data. Alan, what have you got for us?
Yeah, thanks, Mike. Really, I just wanted to go through a few of the most common recession indicators and see where they're pointing. The question of whether or not the U.S. is headed for recession has been on a lot of people's minds lately, especially the Federal Reserve at their recent meeting in December. And what I want to go over in this presentation is a handful of indicators: employment and unemployment, both of those.
Yeah, so you've got heavily skewed data. They always want to make unemployment look less, and they always want to make employment look like it's more.
Yes,
So,
yes, they do. But even with those official numbers, we still have some pretty compelling data to share.
Yeah.
So we'll get to that in just a second. I also want to cover the Treasury yield curve and show how it has uninverted and then reinverted. Look at consumer sentiment, basically how people are feeling when they're surveyed about their economic prospects. And finally, a blood indicator that someone put together to show whether or not we're headed for a recession. So first of all, let's start with this chart presented by Kalani Omawi. Every single time got recession. And what he's referring to here is the civilian employment level and the year-over-year percent change. So basically, each data point here is saying how many people are employed and how does that compare to the number 1 year ago. And you can see that every time the percentage of people employed drops below zero, right? So fewer people employed, that accompanies a recession, either before, during, or after. So all of these negative numbers have these gray bars.
Yes. One of the things that I would like to point out for everybody is when every time it starts dramatically falling, up until the 92 recession, every recession, we were already in a recession by the time it started to fall. And when it crosses that zero line, early on, that was like 69, 74. The recession is almost over with when it crosses the zero line. So recessions being a trailing indicator, they always come out and say, oh, well, we've been in a recession for the last 6 or 9 months or whatever. So we may be in a recession now, but this is interesting that without fail, this only goes negative in recessions. There isn't one false flag indicator in here.
Exactly. And we've got a sample size of 1, 2, 3, 4, 5, 6, 7, 8. And right now would be the 9th time. So possibly we're in a recession right now. That'll be, like you said, a lagging indicator. So it won't be announced and officially declared until after the fact. But we've got 8 out of 8 in the past. And, right now could be 9 out of 9. So pretty reliable indicator here.
Yep.
So I have the same data on the Federal Reserve website in case anyone wants to check it out for themselves. It's just employment level. This is the number here. So I don't know. Is there anything you want to share about this one, Mike?
The only thing is that the previous chart, those big spikes down and up in 2020 and 2022, I guess that is 2021, 2022, 2021, it looks like, they take up so much of the scale that the rest of the data becomes compressed. So the previous chart, it was easier to see what was going on during each recession. In fact, take your slider and go back to like 2019 instead of today, so people can see how the scale will expand. Right now, the scale goes, So now the previous data fills the screen, and that's pretty much what you saw on the other chart, because the other chart was generated by John Hussman, and he chopped off the top and bottom of those big old spikes that are outliers that made it more difficult to get that fine view into each one of the recessions to see what was going on. So
exactly. Fantastic. Okay, now let's look at unemployment. This here is just the unemployment rate. So it's not necessarily measuring what unemployment is compared to a year ago or anything like that. It's just at each point in time, how many people are declared unemployed divided by the entire labor force. So, you can see historically, ordinarily during expansions, the percentage or the proportion of the labor force that is unemployed is falling. There's fewer and fewer people who are unemployed until it starts to curl up slowly. And then we get a recession where the unemployment rises very sharply. And that's sort of the pattern. Yeah, a roll up and then a sharp increase during a recession.
Yeah, you can especially see the curl up from the just before the 1991 recession or 1990, and then every recession after that one. You can see that curl up, and then the recession starts. And we definitely have a curl up going on today. Now, the COVID recession of 2020, that was a different story. That's just suddenly lockdowns and a lot of people losing their jobs just instantly overnight, basically.
Yeah.
So that's the only outlier here. But let's show the audience something a little interesting. Why don't you hit edit graph and do year over year change or month over month. So
from a year ago.
Yeah, and then format.
Oh, okay.
Oh yeah, there you go.
Was it good the way you like it?
Yeah, I think so. That's year over year change, right?
Yes, percent change from a year ago. Yep.
Okay, and so you can see the curl ups and crossing that zero line. You know, if you took that zero line and you put, let me see, it's percent change and it's going to the first scale line is 40. So if you went to like 10, there would be, if you could insert a line there at plus 10, there would be no false flag indicators. This thing would be accurate every single time. Do you agree?
Yeah, I would have to study it just a little bit, but yeah.
Well, it goes positive, and we've got a recession, but there's a few of them in there where it does poke its nose above the zero line, but it doesn't go to above plus 10. So here again, we would have another very accurate indicator, and look at where we are today. That's interesting. We're at a higher level now than any of those false flags that had occurred in the past. Very interesting. Okay, and this is just it's interesting for the audience what you can get out of just poking around on the St. Louis Fred's website. It's if you know how to read charts, and one of the things that I would do if you haven't yet, go to ggsr21.com and look at chapter 3 of the book, The Great Gold and Silver Rush of the 21st Century, because it's how to get the most out of charts. And when you really learn how to read charts, it's interesting.
All right, our next indicator here is the yield curve. We're looking at the 10-year Treasury minus the 2-year Treasury. And you can see that okay, let's back up a second and think about what those things are. So ordinarily, if you're going to loan your currency to the US government, you're going to demand a higher yield to lock it up for a longer period of time. So ordinarily, the yield on the 10-year Treasury is higher than the yield on the 2-year, which means when we subtract those two, we should get a positive number.
So just for the audience again, it's a measurement of risk. And when the 2-year is higher than the 10-year, people think it's riskier to loan your currency to the government for a short period of time than it is over a long period of time. And that's typically some bad news dead ahead.
Yes, exactly. So people are saying like that a 2-year time horizon is actually riskier than a 10-year time horizon, which is very strange when you think about it. But whenever this chart here goes negative, that's exactly what that means. It means that investors sense risk in the short term, but not so much in the long term.